Copper just hit a record high, $6.70 a pound. And Bank of America just said, this isn't the top. It's in the middle of the move. Their target for copper by 2027 is $15,250 a ton. I'm going to show you why that's happening. Then we'll get to gold, then silver, then the rest of the board. Some of this I flagged to my community a month before it happened. I'll show you the chart. Let's get into it. The US imported over 200,000 tons of copper in July. That's the biggest monthly inflow in over a decade. Why is this happening? Well, one word, tariffs. Trump is deciding on refining copper tariffs. Traders are front-running it, shipping metal into the US now, before the door closes. The COMEX London spread averaged over $350 a ton in July. That's the arbitrage. Move metals into the US, pocket the gap, before any tariff walls go up. Combine COMEX and LME inventories, over 740,000 tons. Plus, another 110,000 tons sitting in private storage at US ports. Not even in the official count. Metal is being pulled out of the rest of the world, and parts in America. And that's draining supply everywhere else. The London market has flipped back in backwardation. Cash copper trading over $100 a ton, above the 3-month contract. Widest gap since January on this. One line from StoneX sums up the whole move. The tariff arbitrage is ruling the roost over actual demand growth. So a lot of this isn't the world suddenly needs more copper, it's traders racing a deadline. Now, layer on the supply side. The DR Congo just banned exports of copper concentrate, effective immediately. They want the refining done inside of their own borders, not shipped out as raw ore. The Conoco's LTNT mine, one of the largest copper mines on the planet. I can't pronounce that. Contrary to everyone thinking I'm Mexican, one of the largest copper mines on the planet has suspended their development. And that could stay that way for up to 2 years. And in China, deliverable stockpiles on the Shanghai Exchange nearly cut in half in July, down to 69,000 tons. Falling visible inventories in China. Supply disruptions in 2 major producing regions at the same time. That's the setup trading funds have been piling into. Long positions on scarcity, not hype. Now for the fun part, copper futures just broke out of a reverse head and shoulders pattern. And we were tracking this in the community a month before it broke out. Before the fundamental story I just walked you through had even caught up. That's the whole point of stacking macro with the chart. The fundamentals tell you why a move should happen, and the chart tells you when the market pricing it in. When the market starts pricing it in. Both line up. Now pay attention. Here's the most interesting setup. Copper equities are underperforming the metal for the first time all year. Copper spot down about 5% of its highs. Miners sold off a lot harder than that. Year to date, copper equities are still up 4.8%. The metal itself, 6.4%. That's a gap that wasn't there before. Equities carried a premium commodity all year, over 10% on average through 2025. Now they're behind it. A bullish commodity story, tight inventories backwardation, mine disruptions, terrorist demand, and the equities tied to that story are lagging behind it. That's usually temporary, not a new trend. Looks more like AI-related equity jitters bleeding into the miners than anything wrong with copper itself. Copper outlook stays bullish. The dip in equities gets bought, they catch up to the spot. Now gold. Different mechanics, same theme. Central banks are quietly driving this one. Goldman's central bank buying model, their nowcast, ate 1 tons of purchases for May. On a 3-month average, 67 tons a month. Compare that to the pre-2022 average, 17 tons a month. Central banks are buying gold at roughly 4 times their historical pace. And that's after a pause during the start of the Iran conflict. It came right back once it ended. Now the macro on top. Gold's holding above $42.50 an ounce, 7-week high. And US officials are signaling a ceasefire push with Iran and a deal to protect trade through the Persian Gulf, supposedly. Fuel prices have dropped hard since the start of August. Lower energy costs, less inflation pressure, lower odds the Fed hikes again. Treasury yields eased on that. Lower yields, less opportunity costs to hold an asset that pays you nothing. And in China, institutional investors keep adding to gold-backed positions, partly a hedge against a tech stock volatility, partly because the physical market has been showing real strength. Central bank buying is underpinning that. On the chart, gold broke out of the pennant shape, came back down, tested its exponential moving average. It failed to hold above it. That failure matters. If you're looking to get in, a dip from here is more opportunistic entry than right now, not chasing the breakout itself. By the time a pennant resolves and breaks out, you've usually already missed most of the move. The better risk to reward shows up on the retest, not the breakout candle. Now zoom out. Bank of America didn't just call copper and gold. They laid out targets for every major metal through 2027. Here's the board. Aluminum and copper, the two they were outright bullish on. Deficits through 2026 and 2027 for copper. $12,888 a ton for this year. $50,255 by 2027. The driver, China's metals demand, slowed in the second half of this year, grid spending headwinds, but investment has picked up since. Domestic fundamentals are supportive again. Combine that with the supply story I already walked through, and you get a sustained deficit, not a one-quarter blip. Lead, nickel, and zinc, those have a neutral read. Different swing factor on each. Nickel demand keeps growing out of electric vehicles. The number one thing to watch, whether Indonesia keeps output growth unfettered or starts reining it in again. Zinc is the more interesting one. LME inventories so thin keep getting short squeezes out of nowhere. China holding back refined exports. And they're keeping that liquidity squeeze alive. Now gold and silver, worth separating out. A lot of you trade these more actively. Gold's target, 43.60 for 2026, 40.80.13 for 2027. But Bank of America's own language is worth sitting with. Gold's gotten overbought while still being underinvested. The ETF buying that drove the earlier run cooled off. Prices corrected, even though positioning never got as stretched as prior cycles. Their read. Gold stays a hedge against US macro uncertainty, but a hawkish Fed tilt caps the near-term upside. Silver, smaller numbers, $68 to $70. The risk worth flagging isn't the obvious one. It's substitution risk further out. If industrial demand for silver in solar panels shifts towards materials that use less silver per unit, that changes the long-run picture. In a way, price alone doesn't show you yet. Platinum stays in deficit. Should keep outperforming palladium. Palladium's fundamentals lean softer. Though a Russian output cut caps how big that surplus gets. Iron ore and thermal coal really China policy stories at this point. They're worth having on your radar if you trade anything tied to steel or Chinese industrial output, but they move on different set of triggers. Here's the part I want you to actually sit with. Go down the risk column for every metal on that board. Aluminum, copper, nickel, zinc, gold. The same two risks show up over and over. A correlation in equities over AI concerns. Trade war impact on sentiment. That's not normal. Usually every metal has its own risk list, but the exact same macro thread shows up at the top of the downside case across an entire commodity complex. That's a signal worth tracking. Regardless of what you actually trade, the market isn't pricing these metals on supply and demand alone anymore. It's pricing them partly as a read on whether the AI trade in equities holds together. If you want exposure to the copper move, since that's the standout call on the board, a few days to structure it. Straight copper futures, direct exposure to the metal, options on the correlated ETFs, define risk and leverage, or long options on the miners, which, per that RBC chart, are trading cheap relative to the metal right now. Its own separate setup if that gap closes the way it usually does. I'm not handing you a trade to copy. The trade structure depends on your account size, your risk tolerance, but that's exactly what we break down step by step inside of the community. Real trade structure is not just buy this. So that's the full picture. Copper being pulled into the US on a tariff deadline, while global supply gets squeezed from two mines in a country-level export ban at the same time. Gold being quietly bought by central banks, buying at 4 times their historical pace. Almost the entire metals complex carrying the same AI equity risk on its downside list. If you want the exact chart, we flagged this copper setup on a month before it broke out, along with the rest of the metals and macro breakdowns we're doing in real time, is all inside the community. Links below. See you in the next one.